We're going to talk about cost of capital in this class, and it's pretty easy and straightforward. Reason is that most of this is based on the concepts that we've learned in the previous chapters. So it's going to be a pretty smooth ride. So we'll go through the concepts and then we'll solve some problems based on what we learned in the chapter. So cost of capital. What is capital? Capital is all the money, the investment that we bring from the different investors, and we use that money to buy the assets and then do the operations. So capital primarily is composed of equity, debt, and preferred stock. All that combined together is what we call capital. But none of this is coming for free. For example, if you borrow some money from the bank or from the bondholders, you have to pay them a certain rate of interest, and that is actually the cost of debt. Similarly, you pay a fixed dividend to preferred stockholders, and that is the cost of preferred stock. In the same manner, when it comes to the equity, even though we do not return the equity or we are not compelled to pay them any dividend, that is not a requirement. But the thing is that these capital providers, the equity providers, still expect a rate of return. And if they don't get that rate of return, they're going to sell the stock and walk away. So we have to maintain their expectations, and that expected return that equity holders expect is what we call the cost of equity. Now, um, so here are the different sources of capital: debt, preferred stock, and common equity. Debt can then be of two types: notes payables, which is a short-term debt, and long-term debt is like bonds or maybe some borrowings, long-term borrowings from the bank. But that still, these two components are still included in the debt. Okay, preferred stock is normally just one simple category, and equity can be of two types. One is when you issue new common stock. So you issue new shares to the market, and the market buys the shares and gives you the money, so you get that new equity. But at the same time, when the company earns some money, we pay a portion of that to the common stockholders as dividend, and a portion is retained by the business for reinvestment purposes. And that is what we call the retained earnings. Now, it is easy to retain the earnings because you don't incur any additional cost on that. If you issue new stock, then of course there's like lots of like the documentation, legal costs, and the flotation costs. All that together is what we call the flotation costs. You have to talk to the investment banker, and they have to charge a commission and stuff like that. So there will be a flotation cost, and that flotation cost is usually a significant amount of money, like from 4 to 10% of the stock's price is what goes to the flotation cost. So you would prefer to use retained earnings, but then sometimes you have lots of new projects, and in order to carry on with those projects, you need additional external funding, and you will have to go for new stock in that case. Okay, so these are the three main components of capital, and we will talk about the cost of each of these components. Okay, uh, so let's have a look at the main equation that we're going to use in this chapter. That is what we call the weighted average cost of capital. Now, in short, we call this WACC, weighted average cost of capital. And it is made of these three components. This first component is the cost of debt component. And you can see here we've written WD, which is the weight of debt in the total capital. So let's say if your debt is 40%, then we say that 40% is the weight of debt in your company. And RD is the rate of debt, or you can call it the cost of debt. Okay, this is basically the interest rate that you pay on any new long-term debt that you issue. Normally, if it is not given to you, and some additional information about the bonds is provided, you will have to find the yield to maturity. That yield to maturity would basically be the cost of debt that we're going to use. And we've already learned about calculating cost of the yield to maturity, so that should not be a big deal, right? And this T is the tax rate. So the weight of debt multiplied by the cost of debt and multiplied by 1 minus T. Why do we multiply this with 1 minus T? It is because the interest expense that we pay to the debt providers is actually tax deductible. So the actual cost of debt is less than what we pay to the debt holders, because whatever we pay in interest, we get some tax benefit on that. That is why, in order to find the clear cost of debt, we multiply it with 1 minus T. The second component here is the preferred stock component, and it can be calculated by taking the weight of preferred stock, and weight of preferred stock means the percentage of preferred stock in the total capital. Let's say that the preferred stock is just 10%, so 10% is the weight of preferred stock, and then multiplied by the cost of preferred stock, RP, or rate of preferred stock, you may call it. So that is the cost of preferred stock. And we previously, in the previous chapters, we have learned how to calculate the cost of preferred stock. That is basically the dividend of preferred stock divided by the price of the preferred stock. It is because it's a perpetuity. And the third component is the equity. So WC is the weight of capital, and RS is the rate of stock. So, or you can call this the cost of equity. So when these two are multiplied, we get that equity component of the cost of capital. So these three components are included in the cost of capital. The debt component, this is what we call the after-tax cost of debt component, the preferred stock component, and the equity component. All right. Then whenever we have to talk about the weights, like for example, the weight of debt and the weight of preferred stock and the weight of capital or equity capital. We can use the book values of these if no other information is available, but if the problem provides us the market values of debt and preferred stock and equity, then we will use the market values instead of the book values. And they may also give us like the target capital structure. And what we mean by target capital structure is the optimal where the company wants to go. Like for example, right now the company has 40% debt, 10% preferred stock, and 50% common stock. But their target is to get rid of the preferred stock and make it 50% debt and 50% equity. So then that is what we call the target capital structure. So if the target capital structure is given to you, then we're going to use the target capital structure weights. So we need to keep that in mind. If no other information is given, just the book values of these capital components, then we'll calculate the weights based on the book values. If the market values are provided, we'll use the market values. If target capital structure is given, we'll use the target. If all of the three are given, then we're going to use the target capital structure in order to calculate the weights. So make sure that you understand that so that we can have an easy flow through the problems. Now, the cost of debt is the after tax, and I told you why do we multiply this with 1 minus T, because we get the tax benefit. And which which cost of debt like RD are we going to use? We are going to use the yield to maturity on the outstanding long-term debt. So let's say that we have some bonds issued, long-term bonds are issued, and the market price, of course, is changing. So if we have to calculate the cost of debt, that would be the cost of the new debt at which we can issue the debt. And of course, that would be the yield to maturity on our existing debt. That is what the market is expecting from us. So if the RD is not given, let's say some problem will say that RD is 12% or 5% or 8%. So in that case, it is easy. But if it is not given to you and some additional information like some information about the bonds of the company is given to you, then we'll use that information to find the yield to maturity, and then that yield to maturity will be used as RD. Okay, so I hope that is clear. And here's an example, like we have done this so many times. A 15-year, 12% semi-annual bond sells for this price. What is the cost of debt? So what we're going to do is that we'll use this information to find the rate through our calculator, or you can use Excel. We have done that so many times. That rate is actually the yield to maturity, and we'll use that yield to maturity to find RD, and then RD is multiplied with 1 minus T in order to get the after-tax cost of debt. We're going to do some problems on this, so no worries about that. But this is something that we have done previously and not wasting time. If you want me to do it, I can do it, but you can revisit those bond valuation chapters to have a better understanding of that. Okay, then we of course this is what we call the after-tax cost of debt, so we multiply that with 1 minus T. No big deal over there. Cost of preferred stock, because preferred stock pays a fixed dividend and it pays it forever. So what that makes it a perpetuity. Perpetuity is a fixed payment that takes place forever. And in order to find the present value of a perpetuity, we use the payment divided by the rate of preferred stock. We can rearrange that equation to find the rate of preferred stock. So here's the equation for that. Rate of preferred stock would be the dividend of preferred stock divided by the price of preferred stock. If the dividend of preferred stock is $10 and the current market price is 111.1, then the cost of preferred stock would be 9%. Okay. Remember that this is the current market price of the preferred stock. They might have issued it at $100, but now it has gone up to $111. So we'll use the current market price of the preferred stock. So if this information is given to you and RP is not given, then you would use this formula to calculate RP. All right. The last one is the RS, or the cost of equity. And what we use, normally there are two things that we consider. RS is the marginal cost of common equity using retained earnings. So this RS is basically the cost of retained earnings. And as I previously told you, retained earnings is comparatively cheaper because we don't incur any additional cost on that. We just simply retain, we don't pay it out to the stockholders. However, if we have to issue new common stock, new equity, then we incur a flotation cost, and that makes it more expensive. And in that case, we call that RE, rate of equity or cost of equity still, but this RE is used in our formula for issuing new common stock. Okay. All right. Now, if the RS is not given to you, in the problem, sometimes they will give it, well, RS is 14%. So you simply take that 14% and plug it in the formula. But if that is not given to you and they give you some additional information, then you can use that information to calculate RS. And we have learned all of those techniques in the previous chapters. One of that technique or the method is the CAPM equation. So if the problem gives you the risk-free rate and the market return, and it gives you the bid of the company, of course, it is a clear indication that you can use this information in the CAPM equation to find RS. So you can use that. If that risk-free rate and beta is not given, but instead they talk about the current dividend or next dividend and current market price and the constant growth rate, for example, then we're going to use the dividend discount model that we learned in the previous chapter to calculate RS. So in that case, we'll use this one. There's a third method that we haven't discussed before, but this is what we call the bond yield plus risk premium method. And in order to calculate the cost of equity through that method, we take the cost of debt of the company and add a risk premium for the stock, because stock is riskier than debt, right? So you will, if the cost of debt is 10% and the risk premium that we charge is 5% for in order to invest in equity, then the total cost of equity would be 10 plus 5, that would be 15%. All right. So it depends on what information is given to you. You'll have to use that information in order to calculate RS. And when you have all of these variables for the WACC formula, right, then you will plug all of that values in and find WACC. So the ultimate thing that we're going to learn is WACC. And there's another concept that is the optimal capital structure. We'll be talking about that in a separate lecture. But for now, we are focusing on WACC. All right. So here are some examples, but let's jump to our Excel file that I've prepared and solve some problems over there. Okay, so here you go. And if we understand this first problem, it will solve a lot of the types of questions that you can expect in your upcoming exams. All right. So this problem says that the future earnings, dividends, and common stock price of this company are expected to grow at 8% per year. So that means the growth rate is 8%, either if that is the dividend or the earnings or the stock price, everything grows at 8%. So, you know, when they talk about this growth rate and the stock price, the common stock currently sells for $29.5. That means we're going to use the dividend discount model to find RS. Okay. And its last dividend was $2, so that is D0, and it will pay 2.16, that is D1. We can calculate D1 because we have the growth rate, but again, you know, they're kind enough to give us the D1 as well. Using the discounted cash flow approach, what is the cost of common equity? So we need to find RS. Okay. So here is the formula. If you can recall, let me merge this and all right. If you can recall from our dividend discount model or discounted cash flow model, what the formula that we had was P0 was equal to D1, right, divided by RS minus G. Okay. So in this case, because we are calculating RS, so we simply rearrange this formula in order to find RS. So RS would be equal to D1 divided by P0 plus G. So that is what we do. We take that information, D1, which is 2.16, that is given to us, divided by P0, the current price, 29.5, and plus G, plus the growth rate, which is 8%. That is the cost of equity using the discounted cash flow model or dividend discount model that we have. Okay. Then they have also given us some further information about the stock. If the firm's beta is 1.9, the risk-free rate is 3%, and the average return on the market is 14%, what will be the firm's cost of equity using the CAPM approach? So here in this case, they have given us all the information for the CAPM equation. We have got the beta 1.9, we have got the risk-free rate, and we have got the market return. We can use this information to find the cost of equity using the CAPM equation. And what is the CAPM equation? That is RS is equal to RRF plus RM minus RF, which is the risk premium on the market multiplied by the beta. So equals to, we take the risk-free rate plus we start the parenthesis, the market return, which is 14% minus the risk-free rate, 3%, close the parenthesis, multiplied by the beta of the company. So that gives us, this formula gives us the cost of equity as 23.9%. The other formula, the dividend discount model, gives us 15.32%. So, when we use these different formulas, we get different values, different answers. Okay, and which one is the best depends on which one for the one that you have the most accurate information available for. Okay, and then there is the third method. If the firm's bond earns 12% and the bond yield, based on the bond yield plus risk premium approach, what will be RS? And the risk premium on this method is given as 4%. So we know that the bond return RD is 12% and the risk premium RP is 4%. What will be the cost of equity? We simply add the two, and that comes out to be 16%. Now, if you look at all of these values, these different formulas help us calculate the cost of equity, but they are different methodologies and they have different assumptions. And normally what we do in finance is that we find the cost of equity with all of these methods and then find the average of those, and that is what we consider to be the cost of equity. So what will be the average of these? That will be equal to, we sum them up. So I start the parenthesis, the cost of equity using the discounted cash flow model, plus the cost of equity using the CAPM model, and plus the cost of equity using the cost of debt plus premium. And I close the parenthesis, and because these are three values, I divide it by 3, and that gives me the average cost of equity as 18.41%. Okay, any question on this? All good?
Yes, sir.
All right. Okay, then jumping onto the next one. So this company uses only debt and common equity, so there's no preferred stock. It can borrow unlimited amounts at an interest rate of 11%. So that means RD is 11%. It does not change. So we don't have to calculate RD in this problem. RD is given to us. So I note that down. RD is 11%. As long as it finances its target capital structure. So what is the target capital structure? That should be 45% debt and 55% equity. So I have that other piece of information, and this is the target capital structure. I told you before that if the target capital structure is given to us, then we're going to use these values for the weights of debt and weight of equity. So the weight of debt, according to the target capital structure, is 45%, and the weight of equity is 55%. So these are the weights that we will be using in the formula. Its last dividend D0 was 2.6. Now, from this information, when they start to talk about this information, that means RS is not given to you, and you will have to calculate RS using the dividend discount model. Let's note that information down. D0 is given to us $2.6. Its expected constant growth is 6%. So G is 6%. I note that down. And the stock currently sells at $28. So that is the current stock price. That is P0 for this company. And there are two projects available. Project A has a rate of return of 13%. So I note that down. Rate of return of project A, 13%, and rate of return of project B, 11%. So they're asking us the next question, which project should be accepted? So what are the things that we need to calculate? We have to find the cost of common equity. And that, of course, we're going to use the dividend discount model because that D0 and P0 and growth are given to us. The next, we need to use that, we'll have to use that information to calculate the WACC, weighted average cost of capital. And based on the weighted average cost of capital, we will decide which project would be accepted, project A or project B. So let's first jump on to calculating the cost of equity using the dividend discount model. So here we go. I remove that. RS would be equal to, we use this formula, which is the dividend discount model formula, D1, which is D1. Okay. Okay, so D1 is not given to us, but D0 is given to us. We can calculate D1 from that. D1 is equal to D0 multiplied by bracket start 1 plus the growth rate. Okay. Growth rate is 6%, right? Close the parenthesis, and so that when we do this multiplication, that will become D1 and divided by P0. P0 is $28, and then plus the growth rate, which is 6%. All right, so I got 15.84% as the cost of equity. Now, if you look at that, we have all the information for finding WACC. Here's the WACC formula. For the WACC formula, we need WD, weight of debt, which we have 45%. We need RD, which is the cost of debt, that is 11% given to us, multiplied by 1 minus T, that is the tax rate, which is given to us. WE, weight of equity, 55% is given to us, and then RS, cost of capital, cost of equity, which is we just calculated that, right? So we have all the values, and we can use it to calculate WACC. So WACC would be equal to, we start with this formula, weight of debt, 45%, multiplied by, look at the formula, rate of debt, cost of debt, that is 11%, and multiplied by parenthesis start 1 minus tax rate. Tax rate is 25%. Okay, I close the parenthesis, and plus then we go to the weight of equity, that is 55%, multiplied by the cost of equity, which we just calculated, 15.84, and that's it. We got the weighted average cost of capital. Now, if you look, the cost of debt is 11%, so that means debt is cheaper, but its cost of equity is about 16%. So equity for this company is very expensive. Reason is that equity holders are taking a lot more risk, and they expect a higher return. But if you look at that, I mean, when we use a combination of debt and equity, one component is expensive, but the other component is cheaper. Then, of course, the weighted, when we calculate the rate based on the weights given and the rates given, the average, the weighted average cost of capital is between these two values. So that comes out to be 12.43%. And when we make investment decisions, when we consider a project for investment, we will look at the project and see if that project can give us more than the WACC or not. If it gives us a return which is more than the WACC, weighted average cost of capital, we're going to invest in it. If it doesn't, if it gives us less than the WACC, we're not going to invest in it. Now, so which project should be accepted? That is the next, the last part of the question. Which project should be accepted? Look at the two projects. Project A has a rate of return of 13% and B has 11%. Which one should we accept? A, of course. And why? Because one thing, it is higher rate, but secondly, it is the most important thing. This project A gives us a rate which is more than our WACC. Okay, our WACC, weighted average cost of capital, that is the cost of our capital, that is 12.43%. This project gives us 13%, so it is more than our WACC. So just imagine, what if this project A can give us a rate of return of 12%? Which one are we going to accept? If A gives us 12% and B gives us 11%, which one are we going to accept?
A. Still
A.
close? Yeah.
Well, it is close. Well, that makes sense, but still, it is less than the cost of capital. weighted average cost of capital. So we cannot accept it. We'll have to find another opportunity. Right? It is something like, you know, this cost is you like you borrow some money from the bank at 12.43%, and then you invest it in another bank at 12%. That's not a wise decision, right? You're losing 0.43%. You should be finding an investment opportunity that gives you at least more than what it costs you, right? So we are gonna, based on the given information where it was 13%, we're gonna accept project A. All right. Any question?
Yeah, Professor, when you initially showed the WACC formula, there was the preferred stock component. Is that something we'll consider zero in this case?
Well, yeah. So if you look at the problem, it says the company uses only debt and common equity. So it has no preferred stock.
Oh, okay,
So,
got it.
yeah, so there's no preferred stock. We take it out of the equation. Even if you write it down in the formula, because the value is zero, it becomes zero, right?
Yeah.
Okay, but good question. Thank you for asking that. If preferred stock is given to you, then we'll have to include that in the calculations. Thank you for paying attention to that. All right. Okay, now the next question, and this will require a little bit of more calculation, but nothing difficult, nothing to worry about. What is required from us is to calculate the weighted average cost of capital. Okay. And we'll be using the market value weights. So for that, what we need for WACC, we need these variables. We need the weight of debt, cost of debt, tax rate, weight of equity, and cost of equity. Let's see if we have that information. This company's year-end balance sheet is shown below. So that is the year-end balance sheet. We have some assets and liabilities and equity. Okay. Its cost of common equity is 14%. So RS is given. So that is RS is given to us. That is 14%. One variable is there. Its tax, its before tax cost of debt is 12%. Before tax RD. So of course we'll have to multiply this with 1 minus t to get it to make it after tax, but before tax is given. So that is the second variable that is available to us. And its marginal tax rate is 25%. That is the third variable available to us. Okay. The firm's total debt, which is the sum of the company's short-term debt and long-term debt, equals to 1,183. The firm has 576 shares of common stock outstanding that sell for $4 per share. Now, if you look at the problem, the weights are not given to us. Okay, so we need to find the weights, weight of equity and weight of debt. Again, this problem also does not have preferred stock, so that makes it a little bit easier. Now, how do we get that? They tell us that the company's short-term and long-term debt is 1,183. We can simply use that, or we can take that information from the given balance sheet. So right here, we know this is equal to the total debt should be equal to the long-term debt, which is 1,130, plus the short-term debt, which is 53. Now, why are we using only these two? We're not using the accounts payable and accruals $10 in this calculation, because accruals and accounts payable, we don't pay any interest on those. And that is not part of the financing, the actual money that is coming from the financiers. That is just growing with the business, and we don't pay interest. So we only consider the interest paying debt in the total debt calculations. The total equity is not given, but they have given us the number of shares, 576, and they have given us the share price, $4. So we can use this information to find the total market value of equity. That would be equal to the number of shares multiplied by the share price. Okay, $4, and that comes out to be $2,304. Now, we need to find the total invested capital. And invested capital is actually the debt plus equity, the interest bearing debt plus equity, because that is the investment that is coming from these financiers. So what we need to find is the total debt, which we just calculated, 1,183, and plus the total market value of equity, which is 2,304. Now look at the balance sheet. On the balance sheet, we have an equity of $1,687, but that is the book value of equity. Remember, and I told you in the beginning of the lecture that we are going to use the market value if that is given to us. So because the market value can be calculated, so we'll use that one. And the market value of equity is more than the book value of equity, if you look at that. Okay, so now that we have the total invested capital, we also know the equity, we also know the debt. It is now easy to calculate their weights. How do we calculate their weights? Well, of course, the weight of debt would be equal to the total debt, which is $1,183 divided by the debt plus equity, that is the total invested capital, 3,487. That comes out to be 34% debt, and that 34% debt is the weight of debt we're going to use in the WACC formula. The weight of equity would be equal to the equity divided by the sum of debt and equity, the total. So that gives us 66%. Okay. You can also calculate this because the sum of the two must be 100%. So you can also do it like 100%, okay, minus the weight of debt. All right, sorry. 100% minus the weight of debt, and that will also give you 66%. So that is another way to find if one weight is given, the other can be easily calculated by doing it like 100% minus the known weight. Now it's easy to find WACC. We have all the data. We have RS, we have RD, we have the tax rate, we have the weight of debt and weight of equity. All the things are known, so we can now use that information to find the cost of equity, cost of capital. Okay. Okay, RS, RD, all that is given, so we have everything. Let's copy that formula. All right, equals to weight of debt, 34%, multiplied by the cost of debt, 12%, multiplied by bracket start, 1 minus tax rate, which is 25%, bracket close, plus weight of equity, which we just calculated, 66%, multiplied by the cost of equity, which is 14%. And there you go. The answer is 12.3%. All right. So let me make it in the same format. All right. Okay, so seems like there's another component to it, or this is a different problem. So we have got another problem right here, which is the cost of debt is given to us 11%. That's the next problem. Let me. Okay. This company's capital structure consists of debt and equity. So again, there's no preferred stock. It can issue debt at 11%, so we note that down. RD is 11%, and its common stock currently sells at $4 in dividend, last dividend. So that means we'll have to use the dividend discount model to find RS. Okay. So current stock price P0 is $29.25. Last dividend D0 was $4. Constant growth G is 9%. Tax rate is 25%. All right. Furthermore, what is given to us? Well, and its WACC is 14.25%. So WACC is given to us, actually. We don't have to calculate WACC. That is given to us. But we can calculate cost of equity using the dividend discount model. So the dividend discount model, let me copy that formula for you. Here it is, using the dividend discount model. This will be equal to D1, but D1 is not given to us. They have given us D0, so that would be equal to D0 multiplied by bracket start 1 plus G, the growth rate, which is 9%, bracket close, divided by P0. P0 is 29.25 and plus G, which is 9%. All right, so we calculated cost of equity. Then what we need to do, what are they asking for? What is the percentage of the company's, what percentage of the company's capital structure consists of debt? So that means we have to calculate the weight of debt. Weight of debt needs to be calculated. All right, I can remove that. Now this is a little bit on a different side. What we need to do is, we have to take this formula and calculate the weight of debt based on this. But do we have all of the other variables? If all of the other variables are available, then calculating weight of debt would be very easy. If not, we'll have to do some tweaking around. So what is given? We know the WACC, okay? Weight of debt is what we need to find. Cost of debt is given. Tax rate is given. RS is what we just calculated, so that is given, and weight of equity is not given. So they don't give us weight of equity, and there are two unknown variables in this formula. If there are two unknown variables, we cannot find them. So we have to do some tweaking. And what would that tweaking be? We know that I just showed you here, right? When we were calculating this value, how did we do that? 100% minus the cost of debt, right? So in other words, we can say that WD could be equal to 100% minus WE. WE, weight of equity, could be equal to 100% minus the WD. Right? So that means we will get rid of WE from the formula, and there will be only WD left. So what I can do is I will replace the WE weight of debt with 1 minus D, or 100% minus weight of D. So putting in those values, like whatever is known, we know the weighted average cost of capital, so I use that value. WD is not known, RD is known, I use that, 1 minus T, and plus 1 minus WD, which is actually 1 minus WD is the weight of equity, and then multiply this with RS, which we just calculated, 23.91% or 0.2391. Now, doing this stuff and simplifying this, at the end you will find that WD, which is the weight of debt, that comes out to be 0.62 or 62%. If I have done the addition and subtraction correctly, then that would be 62%. All right. So we found what they were looking for. Any question? All good?
Yes, sir.
Yes.
All right, so I think that's it for today. There's another concept, the optimal capital structure. We can, that's not going to be part of your exams, none of your exams, but that's something interesting, and I thought I would share that with you, but depends. Another thing that you would like to note is that I have extended all of the coming assignments by 1 week, because last week we had some technical issue with Cengage. And some of the students could not submit on time. So I have extended the assignment that is due tomorrow, it's going to be due next week. And then the other assignments have also been pushed back by 1 week. So you have more time for that. All right, that's it for now. And thank you very much for attending the class. Take care and have a good evening. Thank you. Take care. Bye-bye.
Thank you.
You're welcome.
Thank you.
Thank you.
You're welcome. You're welcome. Take care. Good night.